The history of the dollar is a unique case of sudden and successful ascent. From being an insignificant piece of paper to becoming the world's primary reserve currency in just 30 years, the dollar has dominated the global economy. In this article, we'll explore how countries created a currency hegemon with their own hands, one from which they now can't seem to break free. The history of the dollar begins in the distant 17th century, when much of the world traded using the Spanish dollar, a coin made of pure silver, named after the European thaler. The Spanish dollar was minted on a massive scale, as it would be foolish not to capitalize on such an opportunity, especially when your colonies in Latin America held the richest silver mines in the world. The thaler was one of the few coins made of pure silver, so it was used in trade by practically all colonial powers, including Britain with its colonies in North America. These colonies soon declared independence, became the United States of America, and decided not to change what was already working well. Americans quickly renamed the thaler to the dollar and made it their national currency. Losing major colonies certainly weakened the British Empire, but its currency stood firmly in the international financial arena and was not ready to relinquish its position to anyone. By the beginning of the 20th century, half the world still used the pound sterling, and nobody had even heard of the dollar. The United States didn't even have its own central bank. So, what turned the currency system upside down? In 1914, World War I broke out in Europe, and the military expenditures of leading European powers skyrocketed. England, France, and Germany diligently printed money to plug the holes in their budgets. But here's the catch. At that time, the gold standard was in effect in the economy. This meant that countries couldn't print money beyond the amount of gold in their national reserves. Any money printed beyond the gold limit quickly turned to worthless scraps. However, war is costly, so the gold reserves quickly depleted, and the pounds, francs, and marks issued rapidly depreciated. Well, if you can't print money due to the threat of hyperinflation, the only option left is to borrow it. But who to borrow this credit from? All economic leaders were busy solving their own problems and couldn't afford to lend. Fortunately, overseas partners were hardly involved in the war. The United States graciously provided loans to the impoverished hegemons, who used them to purchase American weaponry. Many companies and wealthy gentlemen also preferred to keep their money not in war-torn Europe, but in reliable American banks. As a result, by the early 1920s, half of the world's gold reserves were accumulated in the United States. 20 years later, history repeated itself exactly. While all parts of the world were engulfed in the most destructive war in the planet's history, the states continued to excel in making effective business decisions. Actively loaning to Europe and kindly offering their reliable vaults for the gold reserves of other countries. By 1944, the United States had amassed 3/4 of the world's international gold reserves. Americans looked at this situation and decided, strike while the iron is hot. In 1944, the United States invited representatives from 44 countries, from Australia to the USSR, to a small town called Bretton Woods, to make them an offer that they couldn't refuse. Since the U.S. had accumulated almost all of Europe's gold reserves, why bother transporting bars back and forth across the Atlantic? Let's make the dollar the primary reserve currency for everyone's convenience. You, friends, just use the reliable and portable dollar, and we promise that if you need to, we'll always exchange it for gold. Everything's fair. At that time, the U.S. idea seemed quite reasonable. What other currency could become the primary means of payment in the post-war world apart from the dollar? What other economy could offer a reliable reserve currency besides the American one? The majority of countries decided this system was as reliable as Swiss watches, and the leading central banks joined the gold dollar standard, laying a delayed action bomb in the foundation of the world's monetary system. And the bomb began its countdown. What could go wrong? After the end of World War II, trade slowly began to recover. The quality of European and Japanese goods increased, flooding the market. Demand for American goods, and consequently the dollar, steadily declined. The situation was exacerbated by the active spending of the U.S. on strengthening its international influence. States financed aid programs to allies and military actions worldwide using printed dollars. While the gold reserves remained practically unchanged, the bubble continued to inflate. By the mid-1960s, the amount of dollars exceeded the U.S. gold reserve, and countries realized it was time to reclaim their bars before the dollar depreciated too much. The first to crack was French President Charles de Gaulle. Taking a course towards the independence of the French economy in 1965, de Gaulle announced a unilateral return to the gold standard and demanded that the U.S. return French bars in exchange for green paper. De Gaulle's statement in Washington was seen as an unfriendly gesture, but the What You To general didn't seem to care. The French president went all in, announced France's withdrawal from NATO, and evacuated American military bases from French territory. To confirm its solvency, the U.S. had to exchange dollars for gold and settle with France. Wait, we could do that? Other countries were startled and also reached for their share. An international raid on the Federal Reserve System, the U.S. central bank, began. And within a couple of years, its gold reserves had shrunk by more than 2.5 times. On the horizon loomed the dollar default, which threatened to collapse the entire global financial system. If a fight is inevitable, strike first, thought then U.S. President Richard Nixon, and close the exchange shop. In his televised address in 1971, he stated that he decided to take measures to protect the dollar from international speculation and temporarily suspend the exchange of dollars for gold and other reserve assets. In political terms, this meant that now the dollar is decoupled from gold, and your expectations are your problems. And in general, if you didn't make it in time, you're late. We, they said, promised to exchange dollars for gold, but now we won't give gold because we don't have it anymore. What's that called? Right. A default. How did the whole world react to this? Do you think they protested and sat down to figure out how to put the states in check? No, the country swallowed the refusal to pay debts almost silently and continued to use the dollar. But why? Because when Nixon appeared on TV, the dollar was already used in more than half of international trade transactions. A sudden rejection of the dollar could have incurred much greater costs than maintaining the status quo. It would have been necessary to literally rebuild the global financial system from scratch. Can you imagine the scale of the crisis that would have ensued? I certainly can't. A relatively smooth transition could have occurred if there had been something to replace the dollar with. But by the beginning of the 1970s, the annual GDP of the United States was 1.5 times greater than the economies of all European countries combined. And of course, neither the franc nor the German mark, nor the weakened pound could bear the weight of global trade on their own. In general, in 1996, the global financial community gathered in Jamaica and recognized the unilateral U.S. withdrawal from the gold dollar standard. What else could they do? The esteemed gentlemen in suits decided that now no currency would be tied to gold. Instead, currencies would be traded like other commodities, meaning the higher the demand for the dollar or franc, the more expensive they would be. Do you think this decision evened out the global financial system a bit? No, on the contrary, the Jamaican agreement only added fuel to the fire. The abandonment of the gold standard did not pass without a trace for the American economy. The reputation of the dollar was tarnished, economic growth slowed, and unemployment rose. Despite this, the dollar remained the most sought-after currency, and the United States continued to borrow from around the world at the lowest rates to finance its budget deficit. Plus, the unique currency monopoly allowed the U.S. to literally create money out of thin air. The scheme is as simple as pie, excuse the pun. The government issues the most reliable debt securities in the world. The Federal Reserve System prints the necessary amount of dollars to buy these securities, and then the government uses the proceeds as it sees fit. Central banks around the world generally use a similar form of issuance, but when you print reserve currency, it's essentially a money cheat. The credit recklessness led to the fact that by the beginning of 2023, the U.S. debt amounted to 130% of the entire U.S. economy. and there are serious doubts that a debt of such magnitude will ever be repaid. All right, author, but then why does the whole world still use the inflated dollar and invest in the American economy?